Well, as we head into April, a lot of the talk is around mortgage rates. They've creeped back up. There's a lot going on around the country, around the world. We want to discuss in this market update. Also, going to talk about locking in that rate, why it's so important. We'll get into all that today in this market update. Welcome into the Smart Mortgage Show. Glad to have you. I'm Ben George with Bill Linton, Regional President, Cross Country Mortgage. Bill, it's April, springtime. Usually an exciting time for home buying, and I know it is. I know a lot of people are out and making moves, but there's also this kind of this lingering conversation about rates that are happening because things have tipped back up. And I guess that's kind of I think if you're asking anybody, hey, what are you most curious about right now? It's probably what rates are doing, right?
Yeah, we always get a lot of questions about rates. And to your point, we are in the spring market. A lot of people that decided that they were going to buy and sell in the spring market, they did so when the interest rates were closer to 6%. And a lot of people still have they're invested and they've got a lot of momentum behind them. They're kind of, 2 feet in, both feet into this purchase. So they're invested in it and they're going to see it through, even though rates have over the past couple of weeks spiked up to, close to 6.5%. We were 30-year fixed rate mortgage was really close to 6%, in some cases even under if all the right factors aligned perfectly. But now we're closer to 6.5%. And right now what we're seeing is sentiment is still strong because 6.5 a lot better than 7.5, and over the past few years they've been in that range. Still lower than where we were a year ago. There is some hope that this spike is transitory, and if we can get, the big headline right now is Iran and the Middle East and oil, right? So oil spiking up to $100 a barrel certainly puts pressure on inflation. Mortgage rates, the arch enemy of mortgage rates, are inflation, especially 30-year fixed rate mortgages. So with things, being uncertain in the Middle East, oil uncertain, it has pushed rates higher, close to 6.5%. The question is, how long will they be there for?
Yeah, and that's, I think, the big question, because I think a lot of people, experts, that are out there have been talking about rates continuing to drop, but it just goes to show you that you don't really know what to expect and you can't predict, right? And as soon as you think you know what you're doing, boom, something happens and it throws you off completely, which is why you prepare. And along these same lines, I've been seeing a lot of conversation around locking in rates, especially because of this, right? I think everybody that had been on the sidelines, continuing to wait for rates to drop, that maybe knew they wanted to buy a home soon, put off locking in rates because they thought, well, I can just get a lower rate a little bit later down the road. And now everybody's kind of going, whoa, I meant to lock in rates. Can I go back and do that now? But now that things have kind of crept up a little bit, it again speaks to the importance of locking in the rate if you know you are in the market, right?
Yeah, so we are very strong proponents of locking in interest rates. If you're buying a house and we lock in the interest rate, your rate, and you can't lock in until you're under contract, because the lock is attached to the address of the property, and until you're under contract, you don't have an address to attach to. But we believe even after the rates have spiked, you're going to want to lock in. Here's why. As you said, Ben, as we believe, nobody can really predict where rates are going. So if you lock in, your rate cannot go higher. But if you're locked in and the market cooperates by a certain margin, meaning if rates tick down the smallest increment lower, they're not going to do anything for us. But if they tick down larger than that, interest rates coming down 0.25% or more after you're locked in, we can exercise a float down. So you're protected from rates going up. Doesn't mean that your rate can't come down before settlement. So we always believe in locking in. And also, to your point, we have a lot of people reaching out to refinance. In fact, we reach out proactively to them when we see an opportunity. And we hear it a lot. The conversation is, hey, we think the rate right now is 7.5%. We can get them to 6%. total no brainer as far as a 1.5% decrease in rate, lots of savings. And we hear a lot, well, I'm going to wait until it gets to 5.5. And our question back is, what makes you believe that it's going to go to 5.5? What makes you believe that there's some guarantee that it's going to get lower than what it is? So in that situation as well, we would recommend locking in your interest rate. If between the time we lock in and you go to settlement, rates decrease by that margin to float the rate down, we still have an opportunity for a lower rate. But we have people that were waiting for 5.5, and now, the 6% refinance opportunity has evaporated, and we don't know how long it's going to take for that to come back.
Well, I'm sure when you ask them that too, they probably point to, well, we were at 2.5, 3% just 4 or 5 years ago. So obviously it's going to go back down. Maybe not to that, but it's going to go back down closer to that. But yeah, I think when you zoom out again, we talk about this too. Historically, these are still really, really low rates, and something to keep in mind. I know the job market too is something else we're watching, right? I mean, the war is one animal, but then the economy is another animal too that's keeping an eye on. So, any news on that front, Bill?
Yeah, so basically, the Federal Reserve has two mandates, right? It's to maintain inflation at 2% over the longer term, and also maximize employment. And basically, if the job market is too strong, then that would actually keep interest rates higher. Um, and we added 151,000 jobs in February, which is solid. So it's a mixed bag on the employment front because the labor market's been a little bit fickle and back and forth. It's a hard read for the Fed. So I think if the job market seems too healthy, that signals to the Fed that there's no reason to drop the federal funds rate at that time, which the last meeting they held steady on the federal funds rate. They do expect to one or two decreases in the federal funds rate this year. That is their estimation, their target for this 2026 year. So we'll see what happens because, as we also always say, the story is always developing, and as factors and variables change, the direction of the forecast changes as well.
Well, let's kind of finish there with the forecast. I know things have changed in the short term, but over the course of the rest of 2026 right now, does the forecast shifted at all? I know we were talking about things maybe continuing to be on a downward trend. Is that remaining the same?
Yeah, so we do believe that if you zoom out and look over the longer term, this administration wants lower interest rates to support housing, so they're going to pull more levers. So this Middle East spike that have caused rates to go up 0.5%, hopefully they don't go up anymore, and hopefully that situation gets under control, and then rates start to come back down to where they were, and possibly even a little bit lower, because this administration wants rates lower and they're willing to pull levers to do it. Inflation is within range where they can do that without fears of inflation spiking. So in the short term, it's a little bit less certain because this crisis in the Middle East is driving rates higher. In the longer term, the Fed can control things and hopefully get rates, back into the 5% range. As you said earlier, people talk about when are we getting back to 3 or 4, and it's not actually a good thing to have a 3% rate. That means something's really wrong. There's a major problem in some other area of the economy, and they've lowered rates to support that. We really don't want 3% housing rates, mortgage rates. So even 4%, I think, is a long way off. It's in the fives that seems realistic, and possibly lower fives in the end of 2026 or 2027.
All right. So lots to keep our eye on. I know it's busy, and maybe rates are not kind of what you hope they would be in April, but we'll keep an eye on things as we go forward. If you have any questions for Bill, want to talk about different mortgage options that you might have, and there are maybe more than you expected, you can always get in touch with Bill. Just text the word LEND Again, LEND. Just text the word LEND to 21,000 to begin that conversation with him. Also, check us out online, smartmortgageshow.com. All right, that'll do it for this market update. Subscribe for our next one coming soon. In the meantime, we'll have more lending education coming your way, so stay with us. This program is for informational purposes only. Please consult a qualified professional before taking any action. Bill Litton is a loan advisor and regional president with Cross Country Mortgage, NMLS number 147060.